I'm Brendan Yurik, the CEO of Electric Royalties, a new royalty company focused exclusively on all of the clean energy metals required for the transition to global energy, or clean energy, my apologies. What we're really talking about is rebuilding the global infrastructure, towards a decarbonized global economy. And that's going to have a big impact on a large number of metals, which are, fairly small markets today, like cobalt, lithium, tin, for example, and have exponential growth forecasts over the next 2 decades. And we're looking to acquire royalties on those mines that could supply those metals needed to build out that future. So we've got about 18 royalties to date. We got cash flowing royalty, and we're growing quickly. So it's an exciting time ahead.
It is. Brendan, good to see you, mate. I know you're still on holiday, effectively. So I appreciate you dialing and taking time out for that. Hey, look, we're here for Battery Metals Week. We thought we'd talk to a few people that we enjoy speaking to, get their views on what's happening in the marketplace as things are starting to heat up somewhat. Unless you're in Serbia, of course.
Yeah, that's crazy, right? That Jeddah mine was supposed to be a very big lithium mine, expected to bring up a large amount of the supply that's going to be needed over the next few years, and put a stop to it just like that. Effectively dead in the water. And Rio Tinto is really planning to build that out as a major new unit in their business. So yeah, it's kind of crazy. I mean, the supply side was already very thin. For a lot of these metals, lithium's a bit of an exception. There's a lot of supply in Nevada in clays. No one's ever commercially extracted lithium from clay before, but there's lots of money going into it. There's groups doing that in geothermals in Europe, groups doing it in the oil and gas infrastructure in Alberta. So there's lots of lithium out there, but just a sign of how difficult it is to bring in a mine and bring it in production, and people expecting supply to be there, which quite frankly is not going to, for whatever reasons. This happened to be from environmental, social reasons, but technically there's a lot of projects out there that have challenges as well that are it's going to be tough to bring on enough supply to get where we need to go.
So we spend a lot of our time trying to help retail investors, family offices, trying to understand the vagaries of the market. But even for you guys, there's no way you and Rio would have expected something like this to happen. So jurisdictional risk is a real thing. It's becoming more and more of a real thing in terms of the decision making for investors across the board. So do you think there's going to be bigger repercussions off the back of this?
Yeah, well, look, I think you're seeing that trend globally anyway, whether it's in Chile or whether it's Peru, Argentina historically hasn't been so easy. There's this challenge is really growing across all the planet. And, in a lot of these countries where mineral endowment is really a big thing, where we're getting 30% of our copper out of Chile, and you've seen what's happened there the last couple of years. Peru is a very big metal producer. And the discussions they're having right now are quite frightening for a lot of investors as well. So, yeah, I think there's definitely a trend, globally towards that. Why we've kind of targeted safe jurisdictions. We're looking for really those domestic sources of supply, those deposits within North America, Europe, and Australia that could really fit that bill to provide those metals to gigafactories, under construction locally. Really being, kind of two things. One is the jurisdictional risk, right? When you're going to a country, like Serbia or, even Peru and Chile, where you do have some of this kind of social unrest, it's a challenge, right, to bring these projects online. And, when you're talking about an average 15-year development timeline to bring a project online in production, to have something hit you in year 10 or 12 or 14, like this, where effectively now the project is killed. That's quite frankly, that's one of the big risks about, investing in this space, and why we decided to do this as a royalty company, where you are diversifying that risk. You're not, on the hook for those development costs and capital costs as you build that out. And so, it's a risky proposition. It's definitely an issue that you're seeing not only in Serbia, but definitely in countries around the world.
So where does this go? Because you've got the large part of the economy saying we are going battery metals, we're going health leather for battery metals, because we need to create this greener environment, less carbon emissions, less CO2. We want electric cars. We want all of the above. And then you've got part of the population who says we don't want mines in our backyard. No siree. go do that somewhere else. It's a big kind of conversation, but it's really important for you as part of your decision making. You're part of your diligence process, right? You've got to try and understand where's it going to creep up next. You know, we've known about this with NGOs funding anti-mining projects across South America. We've started to see some of the same things in North America too. California, Nevada is not immune to this, right? So where does this go?
Yeah, well, it's going to be interesting. I mean, there has to be a bit of a meeting of the minds here, I think, where you are practical. You're based in reality, right? You know, if we're going to transition to clean energy, which the world really needs to do, and I think all the governments and most people are pretty much on side with that, we are going to need more of these metals. And so there's going to have to be, call it a little bit of pain maybe, to kind of get through it, or a little bit of acceptance that, to get to our kind of end goal is we're going to need more of these metals. We're going to need more mines. I think of the alternatives. I don't think we're ready to mine asteroids yet, so it's not really an alternative. I don't think we should really be touching the deep ocean. Quite frankly, we know more about the moon than we do about the deep ocean. So why would we do that? We've been land mining for a long time, and I think it's something that we can do responsibly. We really look at the ESG side of things. I think when you look at, stuff like the geothermal lithium that's going into Europe, I mean, that's about as ESG friendly as you could ever be, right? You're, producing renewable energy, and at the same time you're capturing lithium. So stuff like that, I expect definitely, to be kind of taking, priority as we move forward. And we look at that stuff as well. But ultimately, I mean, the supply side is really just, it's really misunderstood how thin it is, right? I mean, when you're talking about some of these metals that we're looking at, there's maybe one district or one project, within a continent of interest, that has that commodity. And so it's going to be very interesting. I think the world, the number of people is shocking that actually understand, some of these metals and their supply side projections. I mean, we cover 9 metals. That's more than most, and definitely in the clean energy metal space. We're the only group out there really focused exclusively on all these. There are groups that will maybe come in, they'll do a graphite royalty, they'll do that, but no one that's really taken the extensive look at the entire space as we have. There's a lot of risk out there. There was a lot of graphite producers that tried to make it in Africa a number of years ago. Those mostly all failed. There's a number of groups in the lithium space that have also tried and gone out there, and equity investors have completely lost their shirt. Nemaska Lithium probably being one of the most recent ones in memory. And so it is a risky space out there for equity investors to get into. I think that's why a play like us, where we're giving them exposure to that clean energy metal space, we're using our dedicated information and due diligence to pick out the ones that we actually, think have a chance of making it through where we see things going here as we move on. And so, but I think we've become a good place for investors to, if they want exposure to this space, they don't have to take the risk of trying to pick out these projects individually, making their own bets on where things will go. We've got a pretty good sense of where things are going. I think if you look at our portfolio right now, it's lithium heavy. Lithium prices were up 400% last year. And so, I think that's going to happen, quite frankly, across all these commodities at some point. But lithium was just the first to go. It was obviously one that was kind of foremost in investors' minds. But prices have been jumping up across all these different metals. 100% basically in tin, 75% in cobalt last year. Copper was like $1.50, not about 18 months ago, right? So now it's about $4.50. And so I think you're going to see this really hit all these different metals all at once. It's an interesting time. It's a very interesting time, Matt.
It totally is. And I want to come back to that phrase you used earlier. It's the thin on the ground. Good projects are thin on the ground, meaning that just because there are lots of companies who purport to be in the business of copper, tin, gold, whatever it is, it doesn't mean they're all going to become mines. And in your business, line of business, you need as much certainty as you can garner that the company will actually get into production. Otherwise, you don't make any money, right? You've wasted your money, right? Yeah. So I'll say this for you, right? But so it doesn't become a complete conversation about royalties. Everyone should have a royalty or two in their portfolio for sure. It's kind of a less risky way of approaching investing in the broader metals and mineral space, right? But for those who perhaps want to, carve their own path for part of their portfolio, What are the things that you look to in terms of the diligence process? We talked about some of the jurisdictional components there, but what else should people be looking at?
Yeah, well, there's a lot. I mean, if you just look at the mining side generally, so, taking out the fact that the battery metal space is a little bit different, processing can be a little bit more difficult. And there's a little bit more challenges to it. Mining itself is a very difficult game. At the end of the day, it's a 15-year average development timeline, right? From somebody who says they're exploring for copper, they put a hole down. It's not like oil and gas where cash flow starts coming out of that right away, right? You hit rock, you assay the core, you might need to spend another $200 million to get it along that kind of 15-year timeline. And along that way, there's about 100 different make or break moments, from permitting to metallurgy, to actually being able to build out a resource that is mineable. And so there's a lot of different make or break moments technically just in any given mining project. I think what the clean energy metal space adds on top of that is the metallurgy. It's definitely the most challenging piece. When you're talking about, you need to get to 99.9 percent purity for battery grade quality and this and that. That's very challenging. And I think if you look at in the graphite space and the manganese space, as those are developing for the EV space, each project seems to be kind of unique in terms of the metallurgy and their approach, and also to finding those off-takers that can actually use that product. And so the metallurgy is definitely something that we focus a lot on. I'd say, a good 25% of our time, 30%. I think the classic ones, if you have infrastructure, if you have a renewable power source definitely nearby, hydropower, something on the ESG friendly side that would help, get into production, that's always a positive. I think you definitely look at management team, but quite frankly, for us, it's more about the deposit, because our royalties are going to stick to that deposit no matter what, even if management, messes up, as it were. So we're not too concerned about management. We always feel like we could maybe help introduce somebody if they need some help on that front. For us, it really is about the deposit. Is this actually going to be a large deposit that off-takers are going to want? I think off-takers are going to want something they know is going to be there for 20, 30 years. Especially when you look at the challenges, how much testing and making sure that product fits what they need when you go through that. So looking at something that could have size, that could be around for a long time. Definitely jurisdictional risk is a piece of it, but there's lots of different technical aspects that go into it. It's hard. I've been doing this for 10 years. I started as an analyst. I've looked at probably 2,000 projects. A lot of them I've looked at multiple times. And so you pick up a lot of things to look at along the way. But metallurgy definitely being that kind of more complicated piece. And then also looking at the ESG side, because that can be a very powerful driver for a project to move forward, in this environment. I definitely think with funding sources, especially as well, being able to actually finance that thing, through to production. So there's lots of different things that we look at. It is a tricky space. I think if you look at guys like, even Elon Musk seemed to have gotten tripped up by mining. The guy can, plan missions to Mars, but he probably thought mining was you dig out a little hole and you throw that ore onto a conveyor belt and it gets processed. But it's very much more challenging than people understand to bring a mine into production.
No, absolutely is, and it takes longer than most people think, and most of the time it doesn't work. But let's go to the ESG bit because for battery metals, it's got to be quite important to get that bit right, entirely right, because the OEMs, if that's your main market, will demand it, or battery makers will demand that of you. And to a degree, I think the industry doesn't quite actually understand what it means. They don't actually have the same same uniform view of what ESG means. And coupled with the kind of greenification or the greenwashing of some of these stories that are out there, it makes for a sort of mixed reading or difficult reading for investors.
Yeah, well, there's always going to be, when there's a trend, there's always going to be those groups that change their name and, to one thing or another, battery metals this, battery materials that. I'm basically just trying to, cap along on the play. And there's a few groups that I saw change them to gold names and then change them right back, a year later. And so, yeah, it makes it challenging. I think if you look at the general mining companies that are public right there, I'd say a third of them are probably zombies right out of the gate, where they're never going anywhere. They don't have a real asset, and investors are probably not going to ever see any returns on them. So there's a lot of wish-wash out there, and there are always going to be those people that, are trying to just do it on the play, us going green and this and that. But, investors really have to kind of look at what the actual assets are, what the plan is, what are they buying into at the end of the day. And, I think getting exposure to all these kind of key deposits in all the safe jurisdictions, like what we've done. I mean, that's something where we've got real assets, we've got real exposure to these deposits, in North America, Australia, and Europe that have a very good chance, I would say, I'm not going to say 100%, but have a very good chance of actually, providing those metals, whether it be lithium or zinc or tin or whatnot, to these end users. So, yeah, you got to be careful is what I would say, right? I mean, there's a lot of dogs out there, and it gets easier to spot them in time. But for if you're a brand new investor coming in the space, I'd always say to new investors coming into the space, I'm glad you met me first, because otherwise you'd lose. What happens, that has happened. New investors come to the space, they find the wrong group. That group, wipes everybody out, and then those investment guys never come back. And it's happened, quite a few times. So, we need more capital to this space. Hopefully that capital can, find a good home and make some money first, so it sticks around.
Well, there in license, I love the phrase "zombies out of the gate." I'm going to use that. It's a perfect description. And I'm 30% is being generous in the wrong direction. I think there's about 30% of projects which will actually make it in some way, shape, or form. The rest is just milking the market. But but back over to some of the growth component, right? So we all invest because of the growth component, right? If I look at the demand numbers across the battery metals, all of them, it would suggest that the mining sector is going to grow 4, 5, 6, 10 times, depending on which numbers you look at. It's a very small space at the moment with very few players, who influence the market disproportionately, I feel. Do you feel that with sort of this new money, which you said we need new money coming in, not just on retail, but also some new institutional money or, new family office money, wherever it's coming from, it's going to have different demands or make different demands on the industry. We've talked about, ESG and the green component for one, but do you think, I'm just trying to work out where the pitfalls are, because they're going to make some demands and say, you need to do it this way. But the reality is we're going to run out of this stuff, or we can't mine enough of this stuff, or not enough success cases in terms of the ability to bring production to meet that demand in here. Do you think we're going to end up in some sort of bifurcated market where there's going to be the green, clean, good stuff, and you get to charge a premium for it? And then there's going to be, well, if you want it, it's here, but we've not done any of that green stuff.
Well, I think it probably will be something like that, where there will always be a premium to certain groups. We do need new money in the sector. I think the exciting part is if you think about the mining sector, relative to the oil and gas sector, which is, essentially what the clean energy metal space is going to be cannibalizing over the next kind of 20, 30 years. The oil and gas sector is about 4 or 5 times bigger than the mining market, as a whole. Clean energy metal space in mining, today it's definitely growing, but 2 years ago it was maybe 5-10% of the market. And so what you're really talking about, though, is a fundamental shift in the mining sector, where the clean energy metal space is going to be 4 or 5 times bigger, I believe, than the traditional mining sector, that we've had for the last kind of 50 years here. So I think that part's exciting. I think the growth profile is incredible. I was reading another report this morning from the International Energy Agency, and they're predicting anywhere from like 5 to 20 times, for lithium, nickel, graphite, and that's just over the next kind of 10 years here. So 20 times increase in supply, that's quite a bit. We don't have to be, we can be off quite a bit on those demand projections, and we're still going to see prices jump, 400 or 500% over the next decade. And I think it's only a matter of time before people start to realize that. Lithium was 400% last year. It's definitely got the spotlight. It's one of the key metals of this clean energy transition. But a lot of these other metals are just as thin. That's the very first thing we did right before we started, was we looked through the projects out there on the supply side for all these metals, what actually has a chance of making it into production, and where would we actually fill that gap. And we're expecting demand shortages really across most of these metals within 5 years. For a lot of these metals, we're already there. Partially because projects, just like in Serbia there, they don't come online as people expect. And that'll always be a thing. That's always, there's a lot of projects out there people thought were going to go into production, obviously, because a lot of money went into them, that ultimately did not make it there. So it's going to be very interesting. I think this would be the space to be in, right, over the next 10 years. I can't imagine, an area of higher growth and potential. And still very few investors actually, in the space.
Do you think it's going to be easier to make mistakes as an investor or as a royalty company going forward? Because if the price is right, you got some pretty crummy projects which will work, but it may take a little bit longer to get the price discovery, or maybe not. I mean, what's your view on the sustainability of the prices across the board for battery metals at the moment?
Yeah, well, look, I think you're going to see, I think lithium prices have jumped up huge. And when lithium prices jump up that much, a lot more projects become more economical, a lot more money comes into the space. And then, you kind of get a bit of a supply demand balance, right? And so, there'll always be little fluctuations like that after a big influx of capital, that's chasing lithium. But I think the interesting thing is, all that money went into lithium. There's still not much money that's going into tin. There's not much money going into zinc. There's not much money going into the graphite space. There's really one private equity group out there that's focused, like we are, on the clean energy metal space, and that'd be Pallinghurst, I would say. But one kind of serious institutional group out there. So yeah, it'll be, I think, across the broad space, and we are, not focused on any one commodity. I think that's the exciting part, is that there will be, probably a pullback a little bit in lithium at some point in time here. Things don't just go up 400% year over year. I think the exciting thing is that you're going to see that general trend of growth, where you look at 400%, 500% increases across all these metals, over the next kind of 5-10 years.
So where does that leave a company like you, right? You're say one of the newer entrants into the marketplace. I mean, you guys have been moving sideways for the year. It's been a really strange 6-8 months across the board, quite frankly. So the commodity prices are shooting through the roof. Equities are sitting waiting to see if we're going to go to war, or if we are going to have the economies crushed by, moves from the Fed or increase in interest rates across the board globally. It's a funny time. But where does this story that we've just talked about, this battery metals thematic that we've just talked about, where does that leave you in conversations with regards to going raising capital to go and make more of these? Create more of these royalties that you want to create?
Yeah, well, it's interesting, I would say. There's a lot of money that's looking at this space. Some of that money can't come into public equities like ours. Some of this money is in stuck in funds and private. But we've had a lot of discussions with groups where because we have access to deal flow, there's groups out there willing to put together funding structures, quite frankly, that are like very favorable, towards us, that you haven't seen before in the mining space. So there's lots of money. There's just a lot less people out there that are really knowledgeable about the space and can actually deploy that capital. So that's the interesting part. I think there's a lot of groups learning. I've talked to a lot of oil and gas investors who are keen to kind of see where do we put our money, because the writing's on the wall there, as well over the next kind of 20 years. And those oil families tend to think longer term as well, right? Kind of have a 100-year outlook. So there's a lot of those groups that are looking and talking to us right now that were not talking to us, 18 months ago, 2 years ago. So, we are going to have to go do some financing here at some point. But I feel very confident this time, that there are definitely a lot of sources out there looking to get exposure to this space, looking how to deploy capital, and they love the idea of a group like ours being able to diversify that exposure, in a lower risk way. So, like I said, it hasn't been a strong suit of ours necessarily, in the past doing equity financing and raising that capital, but the market's changed significantly, over the last kind of 12 months, 18 months.
Yeah, I mean, it really has. I mean, outlook for 2022 is what's your take? I'm sitting here waiting for the market's going to work out what they want to be, and I think the markets want certainty over, Russia, Ukraine, amongst other things. But what's your take on how you play it this year?
Yeah, so when I was focused on the gold space, I hated it, right? I was always, is Fred Bernanke gonna raise interest rates or dial back the tapering? That'd be the impact on gold prices, and everybody's looking at the world right now. What's going to happen in Ukraine? Are we going to go to war in Ukraine? And it's getting over the COVID stuff. So it's a bit of a weird year. When I look at this space, what's exciting is I don't think this trend is going anywhere. We need to do this, as a planet. And so long term, I'm still just strategically looking at, what projects have the best chance of making it. And when you look at a 15-year average development timeline, if you're picking the best projects in year 10, year 12 in that timeline, those are going to be the projects that are, most likely to come online. So we're just, as everybody else is kind of worried about this and worried about that, we're just trying to go out there and use this time and opportunity while we're still one of the few groups out there to just kind of keep growing and looking at good deals and picking up assets, knowing that, over the long term, we're not going to lose.